Welcome back. Today we're going to take a look at some data that may not often be discussed, but I think it certainly is relevant. The FDIC balance sheets. Specifically, what we're going to look at is data derived from the assets and liabilities section of the FDIC, commercial banks and savings institutions. It's reported a million quarterly, released, just updated recently. And we're going to take a look at two specific data sets. Unused loan commitments. It's a total unused credit card lines. That's how much money we have that we're able to spend on our credit cards, but we're not using. Zero balance. Now we also going to take a look at the total assets, the loans to individuals through credit cards, meaning the amount of our credit line that we're using right now, our actual balance. We take a look at the white histogram bars, that's GDP quarterly. The blue represents the unused loan commitments, meaning the amount of credit that we have in our credit cards that we're not currently using. These numbers reflect a year over year change. So from first quarter 2007, we can see GDP was just a hair above zero, about 1%. Now, that's not 1% GDP. That's a 1% improvement in GDP from January of 2006. So the economy was still chugging along. Unused loan commitments, the amount of credit we have also increased. And we see as GDP did increase, so did our credit lines. Why not? The credit is good and, we're all doing well. Well, third quarter 2007, we see here GDP continues to rise, and the unused amount of credit that we have. A lot of us really went out there and got a lot more credit cards. The economy at that period of time looked quite strong. Well, then these lines started to decline, and we saw the first decline in GDP. Now, it wasn't a recession; it was early '08, but it was a decline from the prior year in GDP. And during that period of time, the amount of credit that we had that we were not using declined, which means we started to lean on our credit cards. And if we think about it, from a logical point of view, it really does make sense. The GDP is a delayed, it's a lagging indicator. What's GDP? Gross domestic product. It represents, all the goods and services produced in the country. When we have the same job and the same activities more or less, but we find ourselves using more of our credit cards, it tells us something. Maybe there's a lot of inflation out there. Maybe we're spending a little bit more recklessly, and then I think that over time that will show itself in the GDP. The blue line starts to go down first, and then the white line follows. And then we can see here as we entered third, fourth quarter of '08, the recession, the great financial crash of '08, we see here GDP around 7, 8% year over year decline. And during that period of time, the unused loan commitments, our credit lines also decreased. We really started to lean on our credit lines. Well, this is present day. Again, white histogram bars show us GDP year over year change. The blue represents the unused loan commitments. And we can see October of 2020, this was obviously following the COVID crash. GDP rose. And during that period of time, we also had a lot of stimulus, low interest rates, and a lot of, extra cash kind of floating around there. And that's why our unused loan commitments went up. Maybe with this extra cash, we were able to pay off some loans. Also, our spending really was kind of curtailed. Well, 21 turned into 22, and now we see the unused loan commitments continues to rise on a year-over-year basis, but GDP begins to decline. Now, something's got to give because usually these lines move in the same direction. But for the time being GDP, which the last number was only 2.1%, it really wasn't that hot. That shows us that uh, really the economy is kind of struggling to move forward. Now, does this blue line mean that we're paying off our credit cards or maybe we're able to access new credit cards? It's a little bit uncertain the answer to that. But we know if GDP does not start to rise or this unused loan commitment starts to fall, well, something doesn't make sense because they're usually positively correlated. Here we see 2007 through '09, again on a year-over-year basis. White histogram bars, GDP. The blue lines, these are the total assets, the amount of money we have in our credit cards that we owe. And we see that when we had very strong economic conditions, GDP continued to rise, and 2.5% increase from the prior year in 2007, a year over year basis. during that period of time, low activity on our credit cards. But all of a sudden, early '08, we really started to lean on our credit cards a lot. We took on a lot more credit card debt in early '08. Well, in late '08, we really saw the economy take a significant move to the downside. And eventually we see negative, declining GDP figures. And then we also see the total assets on our credit cards eventually start to decline, but they did not decline until we reached the bottom of the S&P 500. Maybe, this reflects bankruptcies or, maybe other factors. But the fact of the matter is we see before GDP really declined, we saw a massive increase on the amount of assets, loans to individuals, the amount of credit card debt that we were using. Well, this is present day. GDP to 2020, early 21 was on a year over year basis improving. We had very low credit card debt, a lot of stimulus out there at that period of time. But as we move forward in time, we see GDP has really started to decline. And during that period of time, we see the total assets, the loans and the credit cards on a year-over-year basis, 12% increase. Prior to that, 15% increase. If you take a look at, April of this year compared to April of last year, our credit card debt is over 10% higher on average, while the GDP continues to fall. We saw the same pattern in 2008, early '08. We put a lot more on our credit cards before the GDP really began to sink. Now, this it doesn't mean to imply that what we're seeing now is going to necessarily, it's going to be a reflection of what's to come. It's not a prediction of what's to come, but the pattern is interesting that, year over year basis, there's a lot more money placed on credit card debt these days. Well, the white line here is loans to individuals. That's the amount of money that we owe. The blue line is the unused loan. Now, both of these lines are marked as a percentage of GDP. So if you take a look at, and remember the loans to individuals, the unused loans, those are all reported in millions. But what we're looking at here is the total amount. Take the blue line, for example, the total amount of credit that we have divided by GDP. And we can see 2003, this is the x-axis below, 2003, 2004, low interest rates. We had a lot of credit. We didn't use a lot of credit. We were, things are doing quite well. Well, 2008, all of a sudden, this dropped precipitously. During the same period of time, the loans to individuals, this is the white line, is how much we owe on our credit cards, all of a sudden went through the roof. And again, as a percentage of GDP. So if you take a look at the white line as a percentage of GDP, it has a very, very close negative correlation. Now, it's not a perfect correlation because there are other factors at work here. But generally speaking, as a percentage of GDP, as the unused loans go down, the credit card debt goes up. Now, of course, this is obvious. Why are we talking about this? Because take a look at where we are now. The white line, the loans to individuals, is at the highest level as a percentage of GDP that we've seen going all the way back to 1999. And that really is actually quite shocking because the fact of the matter is, take the white line we're talking about. There's two numbers here. It's the loans to individuals. That's our credit card debt. And then there's GDP. That's the economy behind all of us that we all participate in, that pays us our payroll, our salaries, and determines, the inflation and everything else. Or not determines, but measures the inflation. When we have a weak financial base, a weak GDP, and on top of that, we have a lot of credit card debt, that's not a good combination. Ideally, what we want is a very strong, robust economy, a strong GDP, and we want low credit card debt. That means we're making a lot of money. We have zero balances on our credit cards. Everything's paid off and things are great. That's where we were 1999, 2000. Now we had a huge spike up in '09, and then we came down. These are the low interest rates. These are the years of low interest rates, 2012, 13, 14, 15. But we never came back down to those 1999 levels. We never even came back to 2007 levels. So the fact of the matter is, what happened? Did GDP not recover? Well, we had strong economies after 2009. but it really was the loans into individuals as a ratio. We still tend, we still did tend to carry a lot more debt based on the economy underneath it. And now we're at the highest levels we've seen in a very long time. And I think that's kind of troubling. Now, the blue line here represents the unused loans. That's our credit lines as a percentage of GDP. And that currently stands right now. That's the or I'm sorry, the y-axis on the left-hand side, around 22%. The federal funds rate, interest rates, is the right side. That's around 5.5%. We know the Fed just met; they left rates unchanged. Well, going back to 1999, we had actually 6.5% interest rates at that point, and we had a credit line that began to increase and hit highs around 2007. That's the amount of credit we have as a percentage of GDP, around 29%. Our credit lines collectively represent about 29% of GDP, just, apples to apples basis. Well, then we had the financial recession and we used a lot of our credit card debt, and that line went down. But it never really recovered. Currently, we're around 21%. And what's interesting is that when we have a strong economy, high interest rates, and the economy crashes, that's a tech crash of 2001. And then the unused loans, that did rise. It did drop during the tech crash of 01, but then it came back up and we had a lot more credit, on average. And then we had very low interest rates, and this fell as well. Now, it wasn't because all of a sudden we weren't using our credit cards. This reflects a very strong GDP. We had low interest rates and the economy took off. So it's unused loans as a percentage of GDP. GDP rose during this period of time. Well, now this line's starting to rise, the blue line. When the blue line goes up, it means either GDP is declining or our unused loans are increasing. Do we have more unused loans these days? I don't think so. I think this blue line going up reflects a very poor GDP. And I think that the confirmation from that is 2019, 2020. That's a COVID crash. That's not a reflection of a lot more credit out there. That's a reflection of a very fast declining GDP. Now, again, the white histogram bar in the background shows us the federal funds rate. This is the loans to individuals divided by GDP. It means how much credit card debt do we have as a percentage of GDP? Well, back in 1999, it was less than 2%, but 1.75%. Very high interest rates. So we had a lot of, not a lot of credit card debt and high interest rates. So high interest rates don't really bother me if I don't have a lot of debt. Then we had the tech bubble crash, interest rates came down afterwards, and we started to lean more on our credit cards. Interest rates went up. Interesting, when interest rates were low and then they started to rise in 2007. Despite the high interest rates in '07, we still didn't have a lot of credit card debt. The economy was strong. It means in 2007, we might have bought something expensive, but we were able to pay it off. We had a very strong GDP in '07. Well, then we had the financial crash in '08, and obviously interest rates were cut, quite drastically. And during that period of time, we all tend to lean on our credit cards. And then that never really came down. This blue line remained quite high. It did pull down because of the COVID crash, but again, the GDP is the denominator in this calculation. So that blue line going down is a reflection. Well, it was GDP going down that period of time, but then the loans to individuals, this turn down over here, I believe reflects a lot of credit card debt that we're able to pay off because of all the stimulus and a lot less spending. But again, what's troubling here is that during a period of time of high interest rates, we also have a period of time when we have very high loans to individuals. So when we see here a combination of high credit and high interest rates, I think that's quite troubling. So to recap, what we're looking at here, and I think going back to the prior chart, this one here in particular, this is, I think, probably the most telling, is that from 1999 through 2022, it's actually current day. The amount of unused loans as a percentage of GDP has gone down. It hasn't quite recovered But now the loans to individuals, this white line, the most shocking, I think, of all of these charts, shows us that the amount of credit card we have, the credit card debt we have as a percent of GDP, is at the highest levels we've seen since at least 1999. And my guess is a lot further than that. Will GDP start to reflect that in the future? We barely have a positive GDP at this point, so it'll be interesting to see. But it goes to show you the economy is not just non-farm payrolls and CPI. There's a lot of other data, that we can use to measure our economic progress, some less obvious, but certainly very helpful as well. We hope this has been helpful. We look forward to seeing you back soon.